Alright guys, my name is Ricardo Ruiz, and in this video I'm going to be explaining how I started investing in stocks. I remember back in 2018 my father gave me a book called The Intelligent Investor, and I started reading it and started talking about securities and the different ways to purchase stocks. So in this book, in The Intelligent Investor, it, it teaches you about temperament, your emotions when it comes to investing. Emotions Your emotional side of investing is really important because when you lose money, you start to bite your fingers, you start to stress out and worry a lot. So when you invest, it's very critical that you think and ground your emotional self, because you don't want to get emotional and have your emotions do the investing for you. If your money starts going down in your account and then you start feeling all this crazy stuff, that's going to make you want to get out of the stock market, and that's not the way to invest. You want to stay in the stock market. It doesn't matter if your money goes up or down. Okay, if it goes down and continues to go down and we're now in a recession, don't fear just because your money is down. Doesn't mean you lost anything. The only way that you lose money is if you decide to pull your money out of the stock market. When you decide to pull your money out of the stock market, that number, that negative number, is now truly a loss. Okay, so when it comes to investing, don't get emotional. You want to have a poker face, okay? That's the number one thing you need to know about investing in stocks. The number two thing you need to know is researching stocks. You don't want to go out there and buy something that you don't know about. You need to do research. And how I research was by reading books from Warren Buffett, reading books from Benjamin Graham. These are well-known, famous investors that teach you how to buy stocks. They teach you the background of stocks. They also teach you the history of the stock market, which is really important. This information can help you choose the best stocks for your portfolio. Okay. The number three thing to learn about investing in stocks is the financial analysis, the analytics of investing. Like I said before, how you need to research, you need to look at all of the financial statements, and this includes the balance sheets, the income statements, and the cash flow statements. If you're looking at those statements and you are able to discern each line on those statements, you will be a good investor. Okay, so that's my take about investing in stocks. The way I did it was by reading a lot of books, financial books, and they gave me valuable information. I stress on reading a lot because not everybody is there to give you a helping hand. Books teach secrets. It may not teach secrets in the first paragraph, but as long as you continue to read the book, you're going to find your gem. You're going to find the gold. Okay, that's why books are so important. Knowledge is power. Knowledge is money. If you have knowledge, you got to learn how to use your knowledge. Okay, because you can have the knowledge and not do anything. This isn't going to get you anywhere. Knowledge is very powerful. So you must use the knowledge that's in your brain to share to somebody, because the things that you know can help another person, and the things that that person know can also help you.
You need to look at those little notes about revenues, about debt, financing, investment, earnings, okay, especially return earnings. You should look at return earnings to see if the company is earnings, is being kept or transferred over to return earnings. Usually, since it is a public company, they pay off dividends on their stock, and the rest of it goes to return earnings. Sometimes they pay the debt down little by little out of revenues, and sometimes they buy stock. The money comes from return earnings because they got so much return earnings that they can afford to buy a quarter of the stock out of a million stocks or 1 billion stocks out there in the market, and they can afford to buy half of them because they got the earnings, to buy them. Return earnings, that's the treasure chest where the cash is buried in. Okay.
Let's take a look at Company A. Now, let's say Company A is making positive earnings every year, and Company B is making a fluctuation of earnings every year, meaning it's going up one year, Second year, it's going down. The third year, it's going up. The fourth year, it's going down for way worse than the second year. And let's say the fifth year has a deficit year. That's the kind of company that you want to stay away from because of the fluctuation it has from year to year. You want to invest into a company that has a steady increase year to year. Okay. Now let's go to company C. Now, if company C is having from year to year a negative deficit number, how are they operating when it comes to business? What they're using is debt. They're using debt as leverage to keep their business operating, and that is the second thing you want to stay away from. That's the second kind of company you want to stay away from. You don't want to invest into a company that is using debt as leverage, because when a correction comes, this kind of company will not bounce back up. The ones that bounce back up after a recession, after a correction, are the companies that are steadily increasing their money year to year. Those are the kind of companies that you want to invest in, because this will create positive numbers, positive cash flow, positive dividends in your account, so long as they are making positive income year to year.